G'day everyone, welcome to this update for global markets for the 21st of June. And not much has changed in the last week. Certainly markets have been generally fairly quiet. The Australian market has been volatile, didn't end up moving a great deal, but was certainly pretty volatile up and down. But American markets have been quiet, most of the other major international markets the same, and it's really just a case of everyone is nervously waiting to see what happens with Greece. So let's have a look at the main drivers and some of the facts from last week. So the key drivers, quite clearly, is the Greek debt deadline, which is coming up on June 30. I don't think anyone on the planet knows how this is going to play out. It's just a big game of chicken. Both sides have staggering amounts to lose by a Greek default and exit from the euro. Probably Greece more so. But there are certainly some very hardliners in the left-wing government that are pushing for Greece to exit the euro and to go back to the drachma again. And ultimately, that may prove to be their best alternative path forward. But the next couple of years would be absolutely horrendous for the economy. The Greek banking system would collapse, and a staggering amount of wealth would be torn up, and there is money just flooding out of Greece at the moment. So we'll just have to wait and see how that one plays out. The other key driver, of course, is US Federal Reserve policy on interest rates, and a September rate rise is already partially priced into the market. So if there is a rate rise, don't expect the markets to all of a sudden fall over, because that's not going to happen. It's already partially priced in. And the expectations, I think, now are pretty much that we're going to see a very slow and gradual rise in interest rates over a long period of time. And it may be that we just see a quarter point move in September. Maybe we will, maybe we won't. But then I don't think there would be a rise then for quite some time after that. So to me, this is an ideal climate for high quality stocks. Low interest rates, are really a terrific environment for good stocks to do well. Now, I think there's really a new normal in place here. That's a term that gets thrown around all the time. And I'm not saying that necessarily things are, there's a new dimension to financial investing. But I think it's pretty clear now that we're going to have a low growth, low interest rate world for a very long period of time. And we could be talking a decade or more. So that's just the situation that we've got. And that means that you've got to start thinking about your wealth building in a different way. Now, there's some very detailed and very famous research which came out in 2009, which showed that excessive debt levels actually hinder economic growth. Despite what central banks believe and what they've been doing over the last 6 years since the GFC. So that research was pretty clear. And I think the fact that global growth has not picked up, and the American economy is certainly doing better than most, but it's still very, very slow, really supports that research. And the fact is that central banks are just not prepared to tackle the basic issue. And that's why I think we're going to have a low growth world with ultra low interest rates for a very long period of time. So the impact for investors and anyone looking to build wealth is that I think you've got to forget about broadly based investing. So if you're investing in the index, or you're investing across the whole market, or you're pursuing a policy of diversification, which is, it's just such a flawed strategy. They still teach it at Harvard like it's the Holy Grail, but it is just such a flawed way of managing risk. It locks in and guarantees you mediocrity in your returns, and in my opinion, doesn't do anything to insulate you from risk. There are other much better ways to insulate yourself from risk and get a better return. So, it's all about that ratio between return and risk, and there's just so much better way to do it than by, the traditional methods. So for me, this is an era of very astute stock picking, You've got to do your homework. You've got to do a lot of research and really know what your targets are, and also some sharp timing according to the global context. Now, what I mean by that is that there's no point in investing in a great company at a great price if the global sentiment is about to change significantly, such as Greece exiting the euro. Now, if that happens, there is going to be some short-term disruption, and it's going to be substantial. So it's not just a matter of picking great stocks and being aware of the value. You've also got to be looking at the big global picture. Therefore, you've got to be making decisions about how much cash you're holding, and you've got to be pretty smart about your timing as well. So that's the introductory comments. I think it's really important for perspective to cover that quite regularly. Let's get on and look at the markets. The American S&P 500 index gained 15 points on the week, but it was yet another week of sub 1% movement. This is an amazing run that we've had, where markets haven't exceeded 1% from top to bottom in a long time. And the Greek deadline on the 30th of June may provide the catalyst for a breakout. We'll just have to wait and see. Small cap and technology indices, so the Nasdaq and the Russell 3000 and 2000 are showing no signs of weakness. Now, I know some people are pointing to there are more stocks trading below their 200-day moving average, and yeah, that's possibly the case, but also the indices are also continuing to remain quite robust. So yeah, I think any move downwards in the market is going to be a relatively short-term event driven by a bit of fear and panic, and good quality stocks will come back pretty hard. The Australian index it was higher by 52 points on the week, but it was all over the place, and it was really just about the banks being sold, then bought, then sold. Extremely hard work in the Australian market at the moment, and most stocks, including all the good ones, are really under pressure. And what's happening there with those really good stocks is nothing's changed in their business. It's just that they had been trading on crazy valuations for several years, and some of that valuation is now coming out of the market. So let's take a look at a couple of charts. We'll start with the S&P 500. We'll look just first of all at the monthly chart, and you can see that we're just starting to get a little bit of a plateau forming here, but really nothing has rolled over. The price is still comfortably above that blue moving average. It's still above the trend line, which is a very steep trend line. And if we go back to the daily, you can see there's really been no change. We've just got this lengthy period through here, which really started in late February, and really the market has done nothing. So if you're finding it hard work making money in the market at the moment, then that chart there pretty much encapsulates why. Now, turning to the Australian index, just for the sake of it, you can see that there is definitely a short to medium term downtrend in place, and you can see the volatility here: Wednesday, Thursday, Friday, Wednesday up, Thursday down, and then Friday back up again. There's really not a trend in Australia. If anything, the trend is down. And if you look at some of the best defensive stocks on our market, such as CSL and Cochlear and Telstra, and stocks like that you would normally expect to be resilient, they're all really in a short-term downtrend. So definitely the Australian market under some significant pressure. Commodity prices: gold was higher by 19 for the week, kicked up in the last couple of days, but really currency related. The US dollar was down, gold up. I don't think there was a move there for gold in particular. And gold stocks still look weak, and gold stocks do tend to lead the underlying metal. If gold stocks are going down, then you've got to expect that they're probably leading the gold price by perhaps 3 to 6 weeks. So I just don't see any signs at all in the gold market that would give me any cause for optimism at all. Copper slipped back to 256, and that's really pointing to the reality of where we are with global growth. It's really low, and copper had kicked up a bit, as we'll see on the next chart, but is now slipping back, reflecting that the fact that global growth has just not come through as people expected it to. Crude oil still stuck at just a tick under $60, and my view is still unchanged. Still expect it lower yet because there hasn't been enough of the higher cost production that's been forced out of the market yet. There's the spot copper chart. You can see it's been quite a steep decline over since the middle of May. It's dropped from $2.90 to $2.56. That's quite a steep move. And that's just the reality of where we are. So hence go right back to the start of this video. Your basic premise has got to be that for a long period of time, we are probably going to be stuck with low economic growth, ultra low interest rates, and a lot of dangerous triggers such as Greece and commodity prices. There's a lot of things that could upset markets, and that's why sharp stock picking and timing is just so important. Buy and hold, highly diversified investing is just not going to cut it in the future. So the overall strategy, nothing has changed since last week. Local stocks, you should be exercising extreme caution on local stocks. Don't take anything for granted in the local market at all. You only want to buy oversold, and you want to do that with a fair amount of caution as well. The odds favour US index breakout, and I just encourage certainly members and anyone else out there who's listening, just be patient. I know it can be frustrating. It's been hard work the last couple of months, but don't be tempted to try and make something happen. Know what you want to buy, know what price you want to pay for it, and just let the market come to you. And if you're sitting in a high level of cash at the moment, then that's probably a good thing. So that's it for this week. There's my contact details for any non-members that would like to get in touch with me. And let's see what the next week brings. I guess it'll be another week of anxiety over Greece, and hopefully we can get past that fairly soon and get back to markets responding to normal fundamentals. Talk to you next weekend. Cheers.